I just want to thank everybody for joining us on the webinar this morning, and I think it's great to have Joanne Tonetti and also Gemma Mitchell, and we also have Albert Borzillo, who is joining us, as we may have some questions in relation to the small business packages and stimulus. So firstly, I would really like to let everybody know, and as you can see, we're all working from home, that WealthMed, WealthPro and WealthWays, we're all open for business. Our advisors are fully operational, and our 21 team members are all remotely located. So we're here and we're taking care of ourselves so we can take care of you over the difficult days and weeks ahead. So the first thing I really would like to do is to let you know that we are very aware of the impact on client portfolios of the change in the market and the shock reaction to what's happening globally, and that you know, we don't want to be experts in global you know, sell-offs and difficulties, but what I can say is there are a number of people in our advisory team who've been around since the 80s, who have seen 5 or 6 or 7 really serious market corrections. So I think, you know, we do have the experience to draw on, and it's not just information and theory. We've got that experience, and we're right here, and we're going to guide you and help you to make really good decisions as opportunities arise in the coming period of time. So I think one thing that we have seen is that we've seen panic selling and irrational behaviour. And that irrational behaviour assumes that, you know, the market will never, you know, recover. And the reality is this is a health crisis that has very serious economic impacts. The question is, how long will those economic impacts take to move through the economy and move through company earnings, and for us to return to normality? I think too that this decline in markets has been far more rapid than the GFC, and you know, we can probably expect that it'll have a very rapid you know, bounce back when things do start to improve. But anybody with a time horizon of 3 years or more, this presents a very significant buying opportunity. Now, I'm going to come back to that later, but what I would like to do now is address some concerns that our clients will have that are either just about to retire or are already retired. So we have had a philosophy in our portfolio management not to be using growth assets to pay regular payments for pension or superannuation income to people who are retired. So we've had a philosophy that a minimum of 2 years income is kept in cash and fixed interest and liquid investments. And it's for this very reason, so that we aren't selling off your growth assets at the worst possible moment to pay your monthly pension payments. There should be no concern at all that your income can continue. So I think, you know, if you've got any concerns, please speak to your advisors, and they will be able to talk to you about what liquidity you have in your personal portfolio, or log on and have a look at your cash and fixed interest, and you'll see that there's going to be no difficulty paying your pension payments. One thing that is going to happen is that, you know, and your advisors will be talking to you, that your allocation of defensive assets, cash and fixed interest, will be looking to move some of that allocation to shares or to equities in the coming weeks as the opportunities present themselves. So what I'd like to do now is just turn to what's happened overnight, and I think this is an indication of how quickly things can change and will change as things improve or deteriorate. So we are going to have a lot of volatility. I don't think that's a surprise to anyone. But overnight, you know, the US rallied its biggest single move since 1933. And there would be those people who would say, oh, well, it's off the back of what Donald Trump, you know, says. Well, there's definitely an element to that. However, there are some key things that are happening in the US. And when the US is you're working, the world's working. So that's why we're going to spend a little bit of time talking about this. So the key things that are happening is that Congress is working on a $2 trillion stimulus package. And there's $500 billion in loans and guarantees coming through. Now, that package didn't quite get through on a technical issue, but it's quite, there's quite a lot of confidence that that package will get through Congress in their next session. And that has really been a large contributor to markets in the US moving. The other thing that has happened is the United States is testing many, many more people in a very technical testing program with a whole range of analytics in their overlay. So, and why are they doing that? Because it leads to the statement that Donald Trump made, and that is that the US economy is not built to slow down, and that it would create massive damage to their economy for that to happen for any prolonged period. And in his words, they don't want a situation where the cure is worse than the disease. So they are going to be working very, very hard to get their country and their economy back to work as quickly as possible. Now, there was a conversation around large sections of the Midwest and Texas where there is no or very low number of cases. And so they're looking at getting sections of their economy back to work sooner. The statement about getting back to work by Easter, well, I'm not sure about that. But, they're doing a lot of things in terms of stimulus, in terms of testing and locking down to try and get their economy back quickly. In Europe, overnight, we had some really, sharp gains. We've got the G7 meeting going on. Now, what I'd like to talk about is this global response. Now, where we've had difficulties in economic and market corrections in the past, there's been a lot of learning go on from that, and that what has been learnt is that economies, treasurers, bank governors, they need to act quickly and in a big way when there's significant market shocks like this. And we have had unprecedented global stimulus on a coordinated basis to something that could potentially work its way out in the next 6 to 12 months, maybe 18 months. It's certainly not a 10-year structural problem we've got to deal with like the GFC. Now, interestingly, Wuhan, the lockdown's been removed, so there's no quarantine at all, and people are free to move around now. So that sort of indicates that it's a 5-6 month time frame. And I think initially they let it get away from them because they were not, they were almost in denial and not recognising what was happening. I think we, potentially might be a little bit in front of that wave because, we don't have anywhere near the incidence of the cases, and we've locked down and shut borders. I do think we've been a little bit slow, but the doctors and medical professionals amongst us will have an opinion on that, probably that we haven't acted as soon as we could. But I think that we do know what to expect. We do have modelling and numbers, and so we've got more knowledge and information than perhaps those who faced this medical crisis before us. So I think that, value investors, and this is really, where our portfolios come in, that we're going to be looking for earnings from shares. So in our portfolios, we have a very important structure in place that allows us to make decisions on our underlying shares in those portfolios without running around and chasing clients for pieces of paper. So majority of our funds are managed in a way that you've authorised your advisor to manage your portfolio for you, and we can do that. That is quite unlike a lot of clients' portfolios with other advisors out there in the marketplace, where statements of advice and records of advice and individual advice has to be given before we can take decisions. Now, leading up to this situation we're in, we were holding a significant amount of cash in our portfolios, so we will be moving that cash as we think it's appropriate to over the coming sort of weeks and months. So one of the things that tends to give us an indication of, are we at the bottom? Is it going to keep going? You know, we're looking at what's happening in bond markets. We're looking at the institutional investors, and a lot of the institutional investors, such as the big super funds and big fund managers, have kind of sat on the sidelines a little bit. A really key indicator is when the market starts to become capitalised again. Now, overnight, Cochlear issued a capital raising of $800 million. So this is the first indication that confidence is coming back to the businesses and to the large corporates, where they're actually saying, we're going to take advantage of the situation, we're going to raise some capital, and they're doing it at a 17% discount to the share price. So that produces a very significant opportunity for people to buy into a stock that's got all the right fundamentals. And this will start to happen with a number of the big stocks in the Aussie market. So that recapitalisation of the market is an indicator. If you look at you know, what's happening with gold price, so people tend to liquidate gold in a difficult environment. So the gold price is really significantly come off, and once that starts to level off, that's an indication that things are sort of getting settled. We've also got you know, what's happening with the oil price. So the oil price, as people would notice if they're filled up their car, has dropped off the cliff, and that's really a supply and demand. And again, once the oil price settles and a bit of a floor and we start to see a little bit of a tick up, then that's an indicator that we're getting close to the bottom and that things will start to settle down. The other thing is looking at the Japanese yen. So if you look at Japanese investors, typically bring their money home to Japan, and so the demand for the yen increases. So when you look at these few things together, that starts to give you a picture that things might be starting to bottom out, and we might be starting to return to an opportunity to buy. And when you look at that very significant swing overnight in the US, it all happened, you know, and it all happened in a very short space of time. And the Australian market, you know, we had a 10% increase, and it all happened in the last hour off the back of some of the news. So I think my message is, we have the right structure in place to be able to make changes. We don't have clients that are selling off growth assets to pay pension payments. We've got advisors who are on hand and ready to help you. We have the benefit of 15 global offices to gather information from, and we're experienced. We've been through these things already. So, and we're here at work, and we're going to be on hand to take those opportunities as they come through. We would encourage you to call, text, email, speak to us whenever you need to. We're here for you. We will be issuing a bulletin a couple of times a week talking about topical issues, and our first bulletin went out last night that was talking about a range of things. So what I might do now is, if anybody's got questions, click your little chat button on the bottom of your screen, and you can give us a question. But what I might do is just ask Joanne Tonetti, our fantastic senior advisor, to talk a little bit about some things that are relevant for some of her younger doctor clients.
Lovely. Thank you, Carolyn. And look, and thank you everyone for joining our webinar this morning. I think it's a wonderful opportunity to realise, you know, in times of volatility and isolation, that you're not alone, and we are here, as Carolyn mentioned, to help and support you where we can. it's not what happens to you, but what we do next. So what are we at WealthMed doing next for our clients? And so we want you to remember a few things that we've, talked about for many, many years for our clients who, a number of our clients have worked with us for over a decade. And even as we meet new clients and we start them on their financial journey, you'll start to hear from us, or have already heard from us for many years, what we do to ensure when things are great, but when things are not great, what is it that we've put in place to make sure that there's a buffer or there's a risk management plan. So we're going to talk about 2 phases of that, and I'll discuss this first phase and then flick on over to Gemma, our other senior advisor, who'll talk also. So in terms of phase 1 and what are we doing right now and what should you be thinking about right now, and it's around the structure of your lending. So where, if you have a mortgage or an investment property, we will have been passionate in our drive to have your loans structured correctly in ways that you have an offset account, in ways that you have periods of interest-only repayments. You may be locked in at some fixed rates that, when rates were high, you enjoyed a period of savings. Where fixed rates are coming off, we're talking about variable rates that will continue to also go down. So please, we encourage you at any stage of this journey to check in with us so we can, help you navigate at times what is complicated with loans and your bank. So the reality of why we talk about these things and we're so pedantic about getting them right is really playing out for us now. So you may be faced with the situation of standing down from work for a period of time. You may be faced with having tenants who might unfortunately just up and leave a property. So we want you to speak to us when these things happen. We believe, in one respect that, your employment is so stable, and, our doctors in particular and health workers are, in the box seat, so to speak, in protecting our communities, but in also ensuring that your employment is stable. So what we want you to do is, touch base, think about the structure of your assets and your lending, take advantage of the things as they arise. So that's, Carolyn mentioned that we're looking for opportunities and what we do next. So we don't want to freeze like a deer in headlights. We want to be confident that this too shall pass, and it's what we do in this time that will really matter to your future financial success. So take the time to breathe and stop and reflect on the things that we've already done to set you up, and think about what we'll do next. And that's where our portfolios, as Carolyn mentioned, are so very nimble, and at times of crisis, we do take stock and look for the next opportunity. So we're talking to lots of our clients about bringing their contributions potentially forward. So we would normally make contributions towards the end of the financial year. But at the moment, we don't know where the bottom is going to be, but the market will normalise, and this too shall pass. So taking the opportunity to touch base and see if we can make contributions. So that's really phase 1. I'd like to hand over to Gemma and just let her fill you in on a little bit more around what is happening in terms of bank relief and budget stimulus measures. So I will flip on over to Gemma. Thanks, Gemma.
Thanks, Jo. So in terms of what the government's doing, they have obviously made quite a few announcements, and these are ever changing as this situation evolves. So this is something that we'll keep up to date with and keep on top of how it affects our clients in different situations. But this is something that will keep evolving. So right now, there's a stimulus package from the government around Centrelink, New Start, like the job seeker payments. We feel like that doesn't impact our doctors very much at this stage, given the type of employment that you're in. You'll be even in more demand now. But that is something that if you do have renters in investment properties, that is something that may actually benefit you as well, having those packages in place for people that aren't in careers that are also recession type proof occupations. So the main thing that we see as being a benefit to our doctors, if things keep going the way that they're going and things get a little bit worse, obviously we've got plans in place like Joe mentioned, but there are things that the banks are also willing to do. So one of the major things that the banks will be looking at is a potential to defer repayments for a period of time. So most of the banks are talking about this as a 6-month kind of time frame. Now, unfortunately, it's not making payments, it's deferring them. So they will still need to be made at some point. It will add on to the loan time frame, and the interest will still be there, but it can give you some relief if you do have tenants moving in and out. Most of our, well, anybody that has a rental property should have really comprehensive insurance in place, and that would be part of our recommendations. So tenants moving out, having to either drop their rent if you decide to negotiate that, these are things that are covered in your insurance policies. But we do have that extra benefit that the bank is willing to look at deferring payments and things if these things are impacting you. So there's a lot of things happening, and these will become clearer and clearer over the next few weeks, and they will be ongoing and changing as well as they need to. The banks have been really supportive of what they need to do. They've passed on the latest rate cut that was, it was an emergency meeting that resulted in that second rate cut. So most of the banks have passed that on in the last couple of weeks as well. So there's lots that your bank is doing. If we've structured the loans correctly, and as Joe said, have really strong offsets, I can see us sailing through this, but talking to your advisor and talking about your concerns that are specific to you is the most important thing, because there's so much noise out there, and what works for somebody might not necessarily work for you. It's such an individual thing. So getting, just touching base, reaching out to us and having a quick phone call is really, really important to put your mind at ease and make sure that we're staying on track for these long-term goals of yours. Great, thanks, Carolyn.
Thanks, Gemma and Joe. I just thought I would ask if anybody had any small business questions that they did want to ask Albert, if you want to just put those into the chat box. So just as a recap, so we've had one of our attendees request the WealthMed portfolio returns over 1, 2 and 3 months against our benchmark. So we will circulate that with the recording so you can have a look at that. I'm just having that prepared at the moment, up to date. So obviously we have it, you know, we do it for the previous month at the end of the month, and but we'll have that prepared and send that to you. So just to recap, markets are moving, you know, very significantly. There is a little bit of impetus at the moment out of the US that's helping markets to rally a little bit. We can expect things to continue to be volatile. If anybody's got any cash overseas at this time that they're looking to, their strategy was to bring it back to Australia, there are opportunities with the Australian dollar being quite low. Against the US it's 59.91, against the pound it's, you know, it's around that 48 cent mark last time I looked. So we have been helping some of our clients who do have assets overseas that they intended to bring to Australia to to dollar cost average that into Aussie dollars. So there are many things that we can do on the financial sort of scale with the platforms that we have access to. So we can hold any currency on any exchange anywhere in the world. So we can bring cash onto our platform and then bring it back to Aussie dollars over a period of weeks as well. So there are many things we can do to help. If there's any outlying questions around that, please talk to your advisor. So first and foremost, we've always had a strategy for our clients to build assets in their offset account, cash in their offset account. We have got clients who've got 20, 30, 50, 100, 500, $1 million, $2 million in their offset account. And that is a risk management tool. So where we're having any difficulties with tenants, we've got insurance in place that might take a while to claim, we've got cash in the offset account, we can work our way through this. Interest rates are going to be at their historically lowest level for a long time, which does present some significant opportunities as well. We've got our clients who are retired with large portfolios with significant holdings in cash that they're going to be able to receive their pension payments as normal, and maybe even bring some of those defensive assets into the market for a really significant longer term benefit. So I think, the structure of the way that we give advice and what we do is important, and I think that's bearing out now. Everybody is in a good position to either capitalise, to stabilise, or to look to the future out of a difficult time. So just might ask Albert, who is on our call, to maybe just touch on just 2 or 3 things really briefly that people just need to be aware of if he's able to join us. Not sure if he's got that message. Look, if you have any small business specific questions, please direct those to Albert at wealthmed.com.au. His fantastic team's got everything at their fingertips to help with any government grants or assistance and support. Albert, there you are. You might like to chat. No? I'll just... No, he'll look, just direct those questions to Albert in the future if you have them. So I think that sort of concludes the things that we wanted to talk about. I will circulate our portfolio returns for our Australian equity and our international equity portfolios, and we obviously encourage you to keep the conversation going and to talk to us about anything you need. We will schedule some more webinars. They'll probably be a little shorter than this webinar, just to give you updates. So our advisors are attending an update from our Mason Stevens and the investment team in Sydney every morning. We are getting twice weekly reports from our international connection through Azimut, which gives us a feeling of what's happening in the 15 countries around the world that we're connected with. So we have plenty of information coming in, and we'll share things with you as we progress. We do thank you for joining us on the webinar, and we will be sending it in our bulletin for anyone who would like to send it to colleagues or to review it again. So just one last thing, are there any more, if there's anyone got any questions that they would like to put in the chat box for us to address before we finish? No? Okay. So I just had a question, just more detail on where investments will be placed. So we're getting a list provided each day for really significant buying opportunities on the international and the Australian equities front. So in terms of Australian equities, we're looking for great companies with a fantastic future that are trading at a discount. to their asset value, and their dividends are significant. So if we're buying them at 30 or 40% less, then as a proportion, their dividend increases significantly. So every morning we'll be having a list of those companies supplied to us. Our investment team will be looking at that on a daily basis and deciding any changes to our Australian equities and our international equities portfolios. So importantly, our international equity portfolio will be looking at asset allocation. So our international people that sit on our committee will be looking at asset allocations. Should we be more or less exposed to one sector or one economy or another? And that does tend to drive performance results. So there will certainly be countries that are more severely impacted by what's happening and may take longer to recover, and therefore asset allocation to sectors and countries is going to be really important in the coming months. So at a top level, if we get that asset allocation correct and then buy really well valued stocks underneath that and move things around a little in our portfolio, we'll be positioned very well. And as Joe mentioned, structure is so important. So our SMAs, or our separately managed accounts, and our managed discretionary accounts that a lot of our retiree clients are involved in, we're able to manage those investments without chasing pieces of paper from you. So we can do that proactively and we can move quickly. On the currency front, we have moved some overseas currency to Australian dollars over the last little while, and we can do that in seconds, provided we've got you on our platform. So we're very well positioned to deal with all sorts of things that come our way in the coming weeks. So if we don't have any other questions, we might conclude the webinar. Thank you for joining us. We will be sending you more invitations to join us, and we look forward to talking with you in person over the next little while.